Our group will discuss the Libor scandal. So, what is Libor? Libor stands for the London Interbank Offered Rate. Libor benchmarked interest rates used to price mortgages, loans, and derivatives. It used to be the benchmark interest rate at which major global banks lent money to each other in the short term. Libor influenced trillions of dollars worth of financial contracts worldwide, including loans, mortgages, and derivatives. But because of the manipulation scandals and concerns about its reliability, Libor has been phased out. And it's now replaced by more transparent, transaction based rates like SOFR, Secured Overnight Financing Rate in the US, SONIA, Sterling Overnight Index Average in the UK, and there are other regional benchmarks in different currencies.
So, what exactly happened? The process itself was supposed to be simple. Each day, banks were asked to estimate their borrowing rates, basically, how much it would cost them to borrow money from one another. These estimates were averaged to create LIBOR, a benchmark used worldwide, but instead of reporting honestly, many traders and executives at major banks took advantage of the system. They submitted false rates and often worked together, colluding with other banks to push LIBOR slightly up or down. Their, their goal was twofold. First, to increase profits on trades that depended on LIBOR, and second, to make their banks look more financially healthy, especially during times of economic stress like the 2008 financial crisis. What makes this especially damaging is how sensitive global markets were to these numbers. Even a tiny movement in LIBOR influenced trillions of dollars in contracts, from mortgages and student loans to derivatives and corporate financing. In other words, regular people, businesses, and governments all ended up paying the price for this manipulation. And the most shocking part is how long it went undetected for. For years, LIBOR was considered a trustworthy benchmark, when in reality it was being quietly manipulated. By the time it came to light, the scandal had already impacted borrowers, investors, and economies all around the world. So, who was involved? On the banking side, nearly all the world's largest financial institutions were implicated, including Barclays, UBS, the Royal Bank of Scotland, Deutsche Bank, JP Morgan Chase, Citigroup, HSBC, Lloyds Banking Group, and Rabobank. Barclays was the first bank to settle, which set the stage for broader investigations. But it wasn't just the banks, it also came down to individuals. Traders and submitters were the ones actually manipulating the rate, while executives and managers either ignored or enabled the behavior. Regulators also played a major role in uncovering and responding to the scandal. The U.S. Department of Justice, the UK's Financial Conduct Authority, and various Asian regulators launched investigations and levied billions in fines. In short, this wasn't the misconduct of a few bad actors. It was a systemic issues involving global banks, their employees, and multiple regulatory bodies.
Next, we're going to talk about the penalties that were assessed. So there was over $9 billion total in fines, and this was divided between several banks and individuals that were held responsible. First was Barclays. They were the initial bank to settle. They paid a total of $453 million in 2012. This included fines from U.S. and U.K. regulators. Barclays' early admission is what really kicked off the broader investigations. Following Barclays came UBS, which faced much steeper consequences. They paid $1.5 billion in fines, and importantly, some of their staff were criminally charged. This showed that authorities were willing to go after individuals and not only institutions. Deutsche Bank was hit with the biggest penalty. They had to pay $2.5 billion. Multiple regulators were involved, including the U.S. Department of Justice, UK authorities, and the U.S. Commodities Regulator. It became a textbook example of global coordination in financial enforcement. Rabobank, a Dutch bank, paid over $1 billion, with $325 million of that going directly to the U.S. Department of Justice as a criminal penalty. Lloyds Bank was fined about $370 million. Their misconduct wasn't limited to LIBOR. It also extended to manipulating repo rates. And lastly, RBS, or Royal Bank of Scotland, paid around $615 million. They publicly admitted to misconduct, and several traders were implicated. While banks were fined millions, dozens of individuals, like traders, brokers, and rate submitters, were also investigated, charged, and in some cases jailed. One of the most high profile convictions was Tom Hayes, a former trader at UBS and Citigroup. He was the first person convicted in connection with the Libor scandal. In 2015, he was sentenced to 14 years in prison in the UK, but this was later reduced to 11 years. He was portrayed as a ringleader, although he claimed rate manipulation was widespread and approved by senior managers. Several other individuals from banks like Barclays, RBS, Deutsche Bank, and brokers like ICAP were also charged. Aside from individual banks, there was a separate wave of European antitrust penalties. The EU fined several banks, including JP Morgan, Citigroup, Deutsche Bank, again for forming rate rigging cartels. The total for these penalties was about 1.7 billion. So all in all, the Libor scandal led to billions of dollars in penalties, multiple criminal convictions, and lasting changes in how financial benchmarks are regulated today.
All right, moving on to what has replaced Libor since. As we explained earlier, regulators decided Libor wasn't reliable enough because it was based on banks' estimates and several were caught manipulating it. Instead, they've moved global markets to new risk-free rates that are based on actual transactions, which makes them more transparent and harder to manipulate. Each major currency has its own replacement. In the US, Libor is replaced by SOFR, based on overnight Treasury repo transactions. In the UK, they use Sonia, which is based on sterling money market trades. For the euro, it's STR, published by the European Central Bank. Japan uses Tona, and Switzerland uses Saron. The key differences from Libor are that these new rates are transaction-based, usually overnight, and considered to be more reliable. The transition began in 2017. Most Libor rates stopped in 2021, and by June 2023, US dollar Libor was fully discontinued. So today, when banks price loans, mortgages, or derivatives, they no longer look at Libor. They use SOFR, Sonia, STR, Tona, or Saron instead.
To wrap up, the Libor scandal was a turning point in global finance. It showed how a lack of transparency and accountability in benchmark rates could create massive ripple effects, harming borrowers, investors, and trust in the system. The scandal led to billions in fines, but more importantly, it forced regulators and markets to rethink how interest rate benchmarks are set. Now, with new transaction-based rates, the system is more reliable and less open to manipulation. Ultimately, the Libor scandal reminds us how critical integrity and transparency are in financial markets, because even small distortions could have global consequences. Thank you.